So welcome to late April's edition of Cora College. My name is Justin Hewins. I'm one of the senior partners here at Cora. Today, joining us, we have Lindsay Lukacs and Chris Galipeau. I hope I'm saying that right, from Franklin Templeton. So Lindsay, take it off from here.
So much, Justin, and all of Cora Capital, and thanks for everyone taking a few minutes to join us. As Justin mentioned, I'm a market leader with Franklin Templeton, so I have the privilege of working in partnership with folks like Justin and team. And one of the real value adds that Franklin Templeton offers to advisors and their clients is the market views from the best and the brightest in the business. And joined with us today is Chris Galipeau. He's our senior market strategist. He also served as a portfolio manager. He has approximately just a few 33 years in the business. So as you can imagine, he's seen a few things. And obviously with today's volatility, we thought this would be extremely timely to just give a broad overview in terms of what Chris and team are seeing and perhaps some of the opportunity sets, and then perhaps open it up to questions that you in the audience can type in, and any topics related that we can address. So with that, Chris, I will leave it to you.
Okay, Lindsay, thank you. Thanks for hopping on with us, everybody. Finally, I live just north of Boston, and finally, the sun is out in New England. And I can see it's out where Justin is. I don't know if Lindsay, if it's out where you are, but we literally haven't seen the sun in about 3 months. So sun's out here. Hopefully the sun stays out for the stock market. I will walk everybody through our views and opinions here, and we'll focus on 3 areas. We'll talk about the economy, we'll talk about the stock market, and I'll talk about the bond market, and hopefully try and make some sense of what you're hearing in the news, make some sense of what the stock market has been up to here for the last 3 or 4 weeks. It's been a bumpy ride, and what we think is likely to happen on a go-forward basis. So I'll start here and just talk about the economy. And this, I think, is where everyone kind of gets caught up in the headlines. And this has been, the concerns here have been what's pushing the stock market around, so on and so forth. So I want to, I'm going to share my screen with you here and move this out of the way. And I just want to give you a little bit of information on the economy here. So first of all, before we get into this, there's still a lot that we don't know, right? In terms of what the rules are going to be around tariffs, and of course that's caused all the stress here and all the disruption. And we really don't have the final rules yet. I think we've gone from the peak fear part of what it could be to seeing the administration back down a little bit, or turn the dial down a little bit, bring the tension in the room down. And of course, we've seen a pause here for 90 days, and we've seen some things like electronics get exemptions for now. Tariff rate got reduced to 10% for everybody except China and Mexico and Canada. And so that is a little bit of clarity, I guess, and that has allowed the stock market to rebound a little bit. But ultimately, we don't know what the final rules are. And as we sit and wait through this 90-day period, it's logical to expect management teams, and maybe consumers, but definitely management teams, because they don't have the final rules, to press the pause button when it comes to hiring, when it comes to their capital expenditure plans for the year. They're basically going to halt doing anything. And if we were all CEOs on the call here today, we would do the same thing, right? They're not going to go ahead with any plans that they had from January 1 until the dust settles here. And so I think what that leads us to is the economy in the United States starting to slow here in the last, and we can see it in some of the data in the last 30 or maybe 60 days. That's pretty normal. I think a lot of that is because of what I just said. And it's probably going to continue for a little bit until we actually know the rules. So companies can make adjustments to their business model and basically make adjustments to anything as long as they know what the rule set is. And of course, we don't. At any rate, you can see up here on the right in the blue box, this is our estimate for economic activity for calendar year 2025 in the United States. And the number that we have for the moment is 1.5%. And to put that into some framework for you, long-term growth of the economy in the US over 50, 100 years is about 2%. So this is below long-term trend, but we are not in the camp that we're headed for a recession. And as Lindsay said, I've seen a lot of things in 33 years of picking stocks and managing money. One of the things I don't think I've ever seen is for Wall Street to go from thinking everything's okay to thinking the world is going to end, with most of the major firms on Wall Street telling everybody we're going to have a recession, and then 2 days later, after the pause was put on, taking that back and saying, okay, no, we don't think we're going to have a recession. I don't think I've ever seen that. And frankly, we try not to move our prognostications around that much, especially in a situation like this where we really don't know the rules. At any rate, I think it's highly unlikely that we enter recession. The tariffs, wherever they land, are essentially going to act as a tax, as a consumption tax on all of us. And that's not great news, right? But I don't think it's cause for massive alarm heading to recession. I'll have more to say about that in a little bit. The other thing that we should expect here is a little move up in inflation. And you can see here in the orange, our forecast for what we refer to as core inflation for the year is a little over 3%. Of course, the Fed's target is 2. We're sitting, as we sit here today, the number is actually 2.7 or 2.8. And so it's likely here that we'll get a little bump up in inflation in the next 6 to 8 months. I'll give you an example of how that would play through. First of all, the biggest component of inflation is not what most people think. The biggest single category, which is about 30% of it, is related to rent, paying rents. So if you rent a condo, rent a house, so on and so forth, that's not going to be impacted by tariffs at all. So a third of the calculation isn't even impacted. But I give an example where it probably will be impacted. That's when it comes to autos. And so new car prices are in the calculation. Used car prices are in the calculation. Getting your car serviced is in the calculation. Auto insurance is in the calculation. That little basket makes up about 8% of the calculation. But if we're dealing with tariffs that have been put in place to our northern border and southern border at 25%, that will bleed through and cause higher new car prices, which as a result will cause people to shift from buying new cars probably to used cars, and will drive the price of used cars up. Both of those things will drive the cost of car insurance up. It's not dissimilar actually from what we saw in COVID where you couldn't get a new car, and therefore people bought used cars and the price of used cars went through the roof, right? So that's an example of the transmission mechanism from a tariff to causing inflation. The other example of tariffs causing inflation would be something like this, that Justin is the CEO of the North America Widget Company, and he buys a lot of the intermediate components that go into building his widget overseas. And of course, those tariff rates have been put on pause here, but they're still at 10%. So, for example, if we settled there at 10, Justin's buying the components to make the widgets. We refer to that in accounting language as cost of goods sold. But if that is up by 10%, then he has a couple decisions to make. And those decisions, the decision tree is as follows. He can absorb the cost, absorb the additional 10% cost, which, holding a lot of other things equal, would put pressure on his gross margin, his profitability. He can pass the cost on to the people who buy the widgets, which should be fine by him and really doesn't hurt him. But you run the risk there of the consumers not wanting to buy the widget or buying something else called the substitution effect. So it's the elasticity of demand and or the substitution effect. Or Third option, you could put pressure on the suppliers of the widget material and say, hey, I need you to take some of this or I'm going to find a different supplier. Great example of that is Walmart, who of course has massive scale and is doing exactly that. Or he can do some combination of all the three. That's the fourth choice. And that is where most companies will end up. They'll absorb some of the cost, they'll pass some of the cost onto us, and they'll force their suppliers to take some of the cost too. And so all of that in the soup will really depend on each individual company and how they handle that. I don't think we should expect every company to just automatically pass all the price increases on. If that happened, we'd have a real inflation problem. We've had many companies already talk to us about that. Walmart is a good example where they've told us, this is probably 2 weeks ago, in a meeting, told us that they will pass some of the costs on, but they'll actually eat a lot of the costs and put pressure on their suppliers to take the rest of the cost. And so some items in the store might go up in price. Other items might not go up in price. So it's not as if everything in a Walmart goes immediately plus 10%. At any rate, my point there is that each company will have to manage through that. We're likely to see a burst of higher prices here, which is inflation. But our guess there too, much like we don't think we're headed for a recession, is that probably won't be as bad as people think. And I think that's a good transition to talk about just the emotions that are created and talk a little bit about why the stock market reacted so violently to all of this. First of all, we were really surprised by the amount of the quote unquote reciprocal tariffs, which aren't reciprocal at all. They're retaliatory, if anything, and are really geared toward addressing trade deficits with our trading partners. But the shock and awe of it was a lot, and of course put the stock market under tremendous pressure. I think we saw the peak of fear on April 7th, which was a Monday, and that was pretty indiscriminate and panic selling in the United States. Actually, it was all over the globe. And so the stock market here in the U.S. in about a 3-week span corrected 22%. And of course, now the market has bounced back about 14 or 15%. My point there is I think we passed the peak point of losing money, right? I don't think it's likely that we go back and revisit that 4,800 level in the stock market. I guess anything's possible, but the point of max uncertainty and max trepidation, max noise from the White House, I think is behind us. And so what we've seen here in the last couple of weeks is a little bit of maybe thawing of the tension in the room. Part of that is the pause. Part of that is the exemption of electronics. Part of that in the last couple of days is China coming back, doing the similar thing, relaxing tariffs on things coming into China that they need, so on and so forth. So I think the worst of the price pain is over in the stock market. I think that what we should logically expect here, though, is for the news flow to remain choppy, for anybody in the administration to come out and say a certain thing, cause the stock market to get upset. I think we should expect that. So I don't think we're in the clear here with regard to the noise and the news flow. I think its impact on the stock market is probably behind us at this point. And one of the things that I think is interesting to take a look at, and it's kind of hard to wrap your head around, I'll show you some of this data, is the notion that the stock market actually looks forward and is a discounting mechanism, meaning it reacts very quickly to what it thinks might be coming down the road. And then the news flow comes out and it feels terrible. And the stock market is usually priced a lot of that in, I guess is my point. I want to show everybody just a couple pieces of information here in a minute. But one of the things that I think is worth mentioning is from the peak in January until the low of April 7th, the S&P 500 corrected about 22%. And if you look back in history, people get all worried about recessions, right? I mean, you go back and look at every recession in history, the average peak to trough decline for the stock market is about 28%. And so very quietly, the stock market was acting if we were probably going into recession. We don't think that we are, but that's how quickly the stock market will move in discount news. And I'll show you some interesting statistics here in a second. But one of the things that never changes is the stock market's behavior and the behavior of investors, where investors can go from being very positive one day to whatever the reason or rationale is, to being scared to death and very negative in the course of a day, in the course of a week, in the course of a month, whatever. That's exactly what happened here recently. And frankly, it's not that different from COVID. It's not that different from 9/11. It's not that different from what we saw in the GFC in 2008 and 2009. It's not that different from the tech bubble blowing up in 2000 to 2002, which was exacerbated by 9/11. And I can kind of rattle off a bunch of other instances where we go from feeling okay and your account looks okay and there's nothing really to worry about, to all of a sudden it feels like all hell just breaks loose and the stock market goes straight down, right? So I think the damage has been done. I want to show you a couple really interesting things to take a look at. And a few weeks ago, around the low point here for the stock market, we saw some things that we very rarely see. And I want to show you some of that and try and walk you through it at a high level. This is the first piece of information I want to talk about. And what this shows you, without getting into the weeds here, if you look at the top panel, you'll see orange bars. You can see, it looks like there are 3 of them in here. There's a bunch more. There's probably 10 of them, but they were all clustered together. This is a gauge that we look at that measures fear and anxiety, frankly. And we very rarely reach levels that we saw in the first week of April. In fact, we've only reached those levels 13 times in history. And the dates of those are over here. The most important thing for everybody on the call is to realize that when you reach those emotional peaks of despair, where you feel like all is lost, that whatever is driving the situation, in this case, it's tariffs. In 2020, it was COVID and shutdown of the world, right? In the financial crisis, it was the collapse of the financial system globally. What we're going through here is uncomfortable. I don't think it's anything like those other periods I just mentioned. But suffice it to say, the fear reached the points that we saw during COVID and reached the points that we saw during the financial crisis. At any rate, if you look over here to the right, I'll try and blow this up a little bit. You can see that when investors get that nervous and the stock market declines that fast, that forward returns, so 12 months out from those points of panic, the stock market is up, and it's up on average over 20%, and the hit rate is 100%. And so this is one of the tools that we use internally to help us know when it's a good time to buy stocks and when it's not. This is something that very, very rarely happens, and it happened in the first week of April. So if history is any guide, and it usually is, these return numbers might not match perfectly. But what it tells you is when you get periods of fear, and this happens to all of us, and you look at your statement, you might call your advisor team and say, this is really scary. I'm retired. I can't afford to go through this sort of thing. Those fears tend to happen around major market bottoms. They certainly don't happen at tops, right? You get worried at bottoms. And that's what this data really suggests happened the first week of April. So knock on wood that history is a good roadmap here for the future. I 100% believe that it is. There's no reason for me not to believe it. And that's what we should expect positive returns here in the next 12 months. Another interesting way to look at this is this slide. So this is an interesting piece of data that goes back 40 years that really just measures the outlook of quote unquote high net worth investors in the United States. And again, the data set goes back 40 years. And so we can test the data. But what I'm showing you on this slide is that on a percentage basis, most of the people who respond and participate in this survey are extremely negative. In fact, they're as negative as they've ever been in 40 years. More negative than COVID, more negative than 9/11, more negative than GFC, right? And any other period in the last 40 years. Just think about that, right? We've seen a lot in the last 40 years. Same sort of toolkit here, that when everybody is worried, when the news flow and the drumbeat of the news is so overwhelming that you feel like there's no way out and the stock market is cascading down, when you get to that point and everyone is negative and worried, that's about the point the stock market does what you wouldn't expect, something that you wouldn't expect, which is to stop going down and to start going up. This data is very similar to what I just showed you a minute ago. And the stock market on average, 1 year in advance, 1 year forward, is up double digits. Final thing I want to hit on is that the next thing you will hear, if you're watching CNBC or reading the Wall Street Journal or Bloomberg or Fox News or whatever, Fox Business, whatever you're using online, etc., what you're going to hear next is these tariffs are going to have a significant negative impact on corporate earnings. Remember that that is going to be true in some cases. That is not going to be true in all cases, right? But we would expect earnings power to decline here probably for the next couple quarters. And the stock market follows earnings over time. It's the only variable that really matters. It's the politics don't matter. Whoever the president is doesn't matter. The makeup of Congress doesn't matter. What matters over time is the growth of earnings. And so my point here is the next thing you'll hear is earnings are going to be under pressure. This is bad news for the stock market. That's not really true. What I'm showing you here is a simple picture. On the blue bars on the top, or the blue line on the top, is the stock market in the United States. The green line is the earnings power of all the stocks in the United States. The fact is the stock market moves in advance. The stock market dictates. It looks forward, not backward. That's why we just had a 22% correction. The stock market knows that earnings are going to be under pressure. The stock market bottoms here. Earnings have just started to come down. This is true right now today. And then it takes about 10 months for whatever the issue is to work its way through corporate earnings power. 10 months, let's just call it a year. The stock market doesn't wait for that. The stock market doesn't wait for the all clear sign, meaning the stock market will not wait for the pressure on earnings to subside before it decides to rally. Remember, the stock market is looking through the windshield of the car, not the rear view mirror of the car. We already know what to expect. We can model that out and test that out. But it's shocking to see that going back to World War II, after World War II, that the stock market bottoms about a year before earnings bottom. And in that time period, while earnings are still going down, the stock market is actually going up. And so I think we got to that point where we're kind of in the window here now, where we would expect earnings power to be under pressure, but the stock market already knows it. Final thing I'll show you is right here, that everyone gets worried about recessions. This just in, by the time the National Bureau of Economic Research, which is the government office that dates recessions, comes out and says to us, hey, we're in a recession, the stock market already knows that too. And the stock market leads recessions, the announcement of a recession, on average by 90 days, 3 months. Right? And you can see the range up here. It can be as much as 6 months. So again, the notion that the stock market discounts news, everything that's known and knowable is reflected in stock prices. Stock market is moving ahead. Even if we end up in recession, the stock market is already going to be down and start to rally well before we get to that point. We don't think we're headed to this point. Final thing I'll mention, I'll go back to the first slide that I showed you, is what to expect from interest rates here. And interest rates have moved around a lot here in the last couple of weeks. Specifically, the yield on U.S. 10-year notes has moved a lot. There's a lot of reasons for that. I won't go into the minutia on it, but our best guess here is that U.S. 10-year bond yields stay in a range of from 4% on the low side to 4.5% on the high side. That's about right where we are. We're in the middle of that right now. We don't think interest rates are going to 6. We don't think inflation is going to run out of control. We don't think interest rates are going to 3. We don't, right? A recession would cause that. That's not our base case. And at some point here, depending on what the end game of tariffs look like and what the central bank thinks the implications are going to be, they'll start to move to think about cutting rates, right? In fact, I would even venture that if we weren't dealing with this situation with tariffs, the central bank would probably start cutting interest rates in the next month or two, because inflation, which is in the rearview mirror at this point, is 60% off the highs that we saw a couple of years ago, and it's continuing to head lower. So let me sum all this up. The world doesn't end that often. It's not ending now. Yes, this is uncomfortable. Yeah, I know it's scary and it's emotional when you lose money. Remember that the stock market moves ahead of it. What we saw in the first week of April is probably the max point of pain. Market has bounced back strongly here. I would suggest that market's going to vacillate and probably go sideways for the next couple of quarters, which is fine. But I don't think any of this is cause to alter your long-term plans, right? And so remember that when you got together with the advisor teams, you mapped out your goals, your risk tolerance, and all that. If nothing has changed there, then I don't see any real reason to change your plan. In fact, I see every reason really to stick with your plan. So I know that's kind of a high level view, but that's 26 minutes of talking about it. So why don't I'm going to pull the screen down. I'm happy to take any questions that you might have or expand on anything that I said or anything that I missed. So Justin, I'll toss it back to you.
Yeah, Chris, thank you very much. That was great information. So if anyone has any questions, it's on right now. There is a Q&A box that you can type them into at the bottom of the screen. Please feel free to type anything in. I'll relay those questions to Chris and we'll get them answered for you. Hey, Chris, while we're waiting, just to kind of piggyback on the I guess the inflationary pressure that tariffs have the possibility of causing. Is there any insight that you guys have with regard to an offset possibly coming in the form of a change to tax policy?
Yeah. So not only has like the pausing of tariffs helped, and the number of countries that seemingly want to come and work out some sort of have a negotiation with the U.S., both of those things are beneficial. The next thing that we're likely to see here, and hopefully this gets done by the end of May into June, is the Tax Cuts and Jobs Act being extended. That's the first thing, which the administration is pushing for, coupled with deregulation. So removing the red tape to do business in states like Massachusetts, where I was born, or California, it's brutal, right? Illinois, it's very hard to get anything done. Those things will help, but a one-to-one match, I think they'll help sentiment, Justin, right? A one-to-one match, that's not going to take away the sting from inflation. If the Tax Cuts and Jobs Act didn't get passed and you had the inflation, or extended rather, that would be a problem, right? Because I think what most people don't realize, if you look at the adjustments to the marginal tax brackets and the rates before Trump passed this, that the biggest benefactor would not the wealthy people, as people think that's not the case. It's actually the middle class. So if it doesn't get extended, they'll be in the crosshairs of having to deal with higher tax rates and higher inflation. Of course, that would be a bad combo for the economy. So hopefully the administration could get the tax package passed, and we'll see what happens. And they might extend it out too, right? I mean, Trump ran on no taxes on Social Security benefits, no taxes on tips, being able to deduct interest on a car loan, much like you can deduct your interest on a mortgage, and so on and so forth. So they're working on that now, and we'll see. It would behoove them really to get that done as quickly as they can, just for a lot of reasons, and also get some trade deals on the table here signed so we can see what they look like. And I think once either of one of those happen, or if they happen in tandem here, that will be well received by the stock market.
Great, thanks. So I don't see any questions coming up here. So I'd just like to thank Lindsay and Chris for their time today. Really appreciate it. Again, thank you for all the useful information in what has been a very volatile month here in the market.
Yeah.
So thank you very much. Any insight is helpful. Glad to hear that it's not all doom and gloom. So appreciate your time today. Thank you to everyone for joining us. If you have any questions after the fact, feel free to reach out to us here at Cora. And we can get those messages to your advisor or the team here and get them answered for you. All right, take care, everyone. Thank you.
Thanks, guys.